Hello everyone and welcome to today's episode on the results of week 18 2026, where we will cover the market events such as the situation on Magnificent 7, earnings call reporting we have got last week, PCE data, and where we are moving on the market with inflation. And we're going to cover a Fed meeting that has taken place in the mid of last week and what we can expect going forward. Additionally, at the end, I will be sharing my outlook for the next week and where I would expect market may still hold some opportunities. Last week, we have seen a number of top tech giants reporting their earnings. I would like specifically to outline that Google, Microsoft and Amazon has achieved substantial results and also increased their profitability, which specifically pertains where AI considerations are quite often outlooked as more of an unregulated spend and investments on the side of the companies versus the actual feasible output. On the other hand, earnings call for Meta has essentially outlined very little future understanding on the ways they could possibly grow the earnings using the AI, which instantly reflected in a nearly 8% shares drop. It's quite telling. Ultimately, another very interesting part where it pertains to all four earnings, not even growth in operating margins for the top three has managed to move the markets, which also gives you a hint for consideration that possibly we can expect a rather negative move in tech this coming week or going forward. Moving on to PCE data. We have got the latest read and it is 3.5% on a year-over-year basis for the month of March, which is a lift 0.7% on a month-over-month basis from February this year, when inflation was at 2.8%, which was already quite high to begin with. But 3.5%, it is substantial, so which also means that inflation is not only raising, but it is raising fast. On the other hand, core PCE or core inflation that excludes energy and food currently for the month of March is at the level of 3.2%, reflective of the situation we have with Iran and the blockade of 20% of global oil supply, together with 17% of the global fertilizer supply, all sitting at the shores of Strait of Hormuz. Fed's meeting and the outcome has quite predictably made no moves to neither cut rates or raise rates by Jerome Powell, predictably saving all these moves for the time when Kevin Warsh takes the seat. But I would like to outline for you how Fed is actually working and why, on one hand, we have not received major clarity over cutting rates or raising rates, where at the same time we are observing inflation moving up very fast. The situation and how it works. Essentially, Fed has an absolute mandate to increase money supply and spill over liquidity towards the commercial banks, whereas commercial banks, on the other hand, has an absolute right to increase the M2 money supply via commercial lending. Depending on the situation, commercial lending on the market can be performed through the real estate market or through the commercial lending into businesses privately owned or corporately owned. And the situation is that if the increase in money supply on the market is happening faster than whatever moves upward or downward the Fed can execute on the rates themselves would have little to no impact. Here's the example. If you are increasing on the market empty money supply by 1% a month and your average rate cut or hike is going in incrementals at 25 percentage points, it makes little to no difference. Reason being, it will take you 4 months of rate hiking or rate cutting to compensate for 1 month of quantitative easing. And truth is that Fed is running a quantitative easing and has been running it since December last year. This is another reason why we are observing a higher growth of inflation. And this is also happening in addition to the situation where the foreign lenders buying out American T-bills is becoming a little bit less predictable in terms of so-called de-dollarization trade. Again, there is several angles to it, and it's not that one-dimensional, but the truth is that yes, indeed, with every major moves from the US, we are seeing a trend where foreign countries starting to reconsider as to whether or not they would actually like to own the US debt. The situation with Bank of Japan actually doing monetary interventions last week also do not support so-called carry trade or the situation when number of institutions, they would borrow money in Bank of Japan in yen, convert it into US dollars and buy at least US treasuries or maybe some US equities. But this game has only been possible because the currency exchange rate between US dollar and the yen has been incredibly stable, and also the Bank of Japan rates were nearly zero. Now, when Bank of Japan does financial intervention by buying yen, which causes the valuation between US dollar and yen to go down, all of a sudden it becomes much less profitable to borrow in yen and convert into US treasuries, enjoying the yield. As much so that it creates a selling pressure on T-bills and US equities. And this is happening in addition to slightly broader de-dollarization trend that we are currently observing on the markets. And we will see what the next week will bring us in terms of geopolitics. But right now, dollar and the petrodollar system is mainly holding on the fact that there is no good alternatives to it. And moving forward for the week 19, here is my outlook. Not a financial advice, but this is what I'm closely watching. Oil. As we do not see any improvement of a major scale towards the war in Iran situation, we can expect that the price of oil may go even higher, also taking into consideration that the global reserves I'm referring here to safety reserves of oil that have been running for the last couple of weeks, are essentially draining. That's one side of the thing. Second is agriculture. Same factor. Strait of Hormuz remaining closed essentially cuts down 17% of global fertilizer supply that has been coming from Bahrain, which means the prices for fertilizer will be spiking to additional growth, which also means price action in food. Okay? Then another thing that I would be watching is obviously gold and steel. For the latest two, I would suggest you take a look at CFTC COT commitments of trade reports that essentially are being released every week on Friday and gives you an understanding as to what institutional money are doing and what the price action expectation is for the week to come. I hope you found this video interesting and educational, and I will see you the next time.